Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azuz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. On this episode of the podcast, we have a special guest, Barry Ritholtz, co-founder, chairman, and chief investment officer at Ritholtz Wealth Management, host of the Masters in Business podcast on Bloomberg Radio, and most recently, the author of the book, How Not to Invest, the Ideas, Numbers, and Behaviors That Destroy Wealth and How to Avoid Them. Welcome to Wealthy Behavior, Barry.
Well, thank you so much for having me, Sammy.
Absolutely. I really enjoyed the book. You've been creating great personal finance and investing content for a long time, and I've consumed a lot of it, and I've shared a lot of it. And this book was a new direction in the time that I've been following you. Why was it important for you to write this book?
So, Bailout Nation came out 15 years ago, and I'm like clockwork. Every 15 years, I crank out a new book. Look for the sequel to this in 2040. No, in all seriousness, I've had a bunch of publishers and friends say, "Hey, when's the next book out?" And having written a book or two, it's a lot of work. It's exhausting, and once you submit your manuscript, all right, now I'm done. Then the editing process starts, and then you finish that, and then the promotion and marketing process. So I was like, "Hey, I'm busy. We're standing up a firm, and we're trying to get to $10 billion. We're between 5 and 6 now." My friend Morgan Housel had been nagging me, and then the pandemic hits. And I'm like, all right, let me take a look. I got a little extra time. And I start sifting through some commentary that I've written and quarterly calls for clients and research. And, everybody anyone who knows me from the financial crisis, 08, 09, but I've been writing for a decade before that. And I just started looking at stuff I wrote in 2000 and 2005, and before anyone was paying attention. And it's kind of interesting that first, it's fascinating to see the stuff I used to write where there was no response. But more interestingly, hey, were you right or wrong? What was the uptake when you said this cover story in May 2000 about Cisco is the one stock to own? How did that turn out? And so it was an opportunity to revisit things now that we know how the movie ends. Hey, it turns out Cisco wasn't the one stock to own, and you shouldn't have owned it instead of Microsoft or even GE, as Fortune recommended. The stock proceeded to fall 95% from that cover story. And I want to say 25 years later, it's just about break even to that story, but it's still like 5-10% below the March 2000 peaks. So I was, a little reluctant to do another book. And so, since we're in my office, I could show you this. I have this giant bulletin board on my wall, and I just started writing down, different broad topics, different chapter ideas, and I put I had a whole 100 different things, and I put it on the bulletin board, and you start moving around. I'm normally digital and software based, but sometimes just seeing it like that gives you some insight, and they just kind of self-organized. Hey, here's a lot of really bad ideas that people believe and share. Here's some terrible numbers and understanding of compounding and inflation and dollars and why everybody gets this wrong. And then the behavioral stuff was giant, but I kind of felt, nobody wants another book on behavioral economics. It's, I think between Jason Zweig, Morgan Housel, and Danny Kahneman, we're good. We have everything we need in that space, at least for now. And so I tried to take a slightly different approach to the bad behaviors. And once I had an idea of, hey, I don't want to, it's been a century and tens of thousands of books telling people how to invest. Most people are still pretty crappy investors. Maybe instead of telling people what to do, if we just said, here's what not to do, we'd all be better off. And that's what, all right, I got a book out of that, and maybe two, who knows?
Yeah, it's a very good book. And I did want to ask you about that approach. While the book isn't solely about what not to do, it is focused on avoiding money mistakes. And I was curious why attack the topic that way. Is that, in your mind, what gets in the way of people's investing success primarily? Or is it also perhaps a more realistic path to help people by focusing on mistake avoidance than any other way of improving their investment returns?
So, a couple of great quotes. I dedicate the book to the two Charlies, Charlie Munger and Charlie Ellis, who each have a different way of advising people how not to invest. Munger, in the most Charlie Munger way possible, was once asked, "Hey, are you and Warren just smarter than everybody else?" And Munger says, "It's not that we're smarter than everybody else. We're just less stupid," which really just chef's kiss Charlie Munger. And, Warren Buffett later goes on to say any IQ points in the investment industry over 125 are just wasted. And so it's not a matter of being smarter, it's a matter of being less stupid. But perhaps my favorite discussion of this comes from Charlie Ellis. People who may not be familiar with Charlie Ellis, he's legendary. He founded Greenwich Associates. He was on the board of directors of Vanguard Group. He was the chairman of the Yale Endowment, and oversaw the work of David Swenson. So just a legendary guy. And in the 1970s, he wrote a paper, later became a book in the 1990s, and it was titled Winning the Loser's Game. And he draws the parallel between investing and tennis. So I play tennis, started in my 50s. And, in the world of tennis, there is a winner's game and a loser's game. Who plays the winner's game? Well, the 0.01% of people who are professional tennis players. The way they win is they hit with power. They serve precisely, scoring aces. They kiss the line. They use fancy spins to keep the ball all but impossible to return. They keep the ball away from their sweet spot of their opponent. That's how professionals win. They win by scoring points. The other 99.9% of tennis players, duffers like me, we lose by making unforced errors. We double fault on our serve. We hit it long. We hit it wide. We hit it into the net. We hit it right to our opponent's sweet spot. And all you need to do is make fewer unforced errors in tennis. I play with a bunch of young studs who just crush the ball right into the back wall. And so they're younger than me, they're faster than me, they're stronger than me. I consistently beat them because all I do is just return the ball. Just get the serve in. You don't have to hit 120-mile-an-hour serve and just kiss the inside. Just get the ball in. And it sounds so simple, but to Charlie Ellis's credit, he draws the parallel to investing. Everybody wants the next fill in the blank. NVIDIA, Microsoft, Apple, Bitcoin, whatever it is. And we're so desperately chasing alpha that most of us don't even achieve beta. We don't even get market results. We're so busy trying to beat the market. One more sports metaphor. I grew up a Mets fan. The Mets had this home run hitter named Dave Kingman. Does that name ring a bell? Might be a little before your time.
A little bit, but I know him.
Kingman was famous for hitting these 600-foot home runs. They would break the windshields of cars in the parking lot, but he struck out constantly. He had a mediocre batting average, a mediocre on-base average, didn't really add to the team's win-loss record, but when he hit a home run, it was an event. And it feels like too many investors want to be like Dave Kingman instead of what every little league coach tells the kids. Just get some wood on the ball, good things happen. Hey, just make fewer mistakes. Stop going swinging for the fences. You'll be much better off.
If you could wave a magic wand and fix one enduring investment mistake that you see people make regardless of the environment, what would be the number one thing you'd like to see people do less of? And then I'm going to ask you, in this environment, what do you feel people are most susceptible to doing as an investment mistake?
That's a really complicated and interesting question. So I'm going to give you a very broad answer.
Sure.
I wish people, if I could wave a magic wand, okay, from let's call it June 1st forward, everybody has to think for themselves. Stop chasing gurus, stop listening to market forecasts. Nobody has the secret formula. No, this Substack isn't going to make you money. No, that guy on TV isn't going to crush it. No, this magazine cover. Ted Sturgeon famously said, so he was a science fiction writer in the 50s and 60s, and people used to give him grief over how mediocre so much science fiction was. And Sturgeon said, hey, listen, 90% of everything is crap, now known as Sturgeon's Law. The same is true for SPACs, for mutual funds, for individual stocks. And the same is true for the endless fire hose of media noise. It's not just Bloomberg, CNBC, Fox, and CNN. It's not just Fortune, Forbes, Barron's, Business Week, go down the list. It's TikTok, it's Instagram, it's Twitter, it's Facebook. There is just an endless fire hose from people who don't know you, don't know your tax bracket, don't know your financial needs or goals, don't know your situation, giving you financial advice that typically is them selling a book. In my book, I literally disclose, I said, everybody's selling something. Here's what I'm selling. We run an asset management firm. I want your money. We collect a fee on that. I host a podcast. I want you to listen. I'm selling a book. I want you to buy the book. Those are my disclosures. You have to ask yourself that question for anybody you see giving you financial advice that perhaps they don't have your best interest in mind. They're selling something. So learn to think for yourself. Question why people are, so freely offering advice that perhaps isn't really relevant or suitable for you. Just be a little less gullible. I grew up in an era when my mom always told us kids, never take candy from strangers. And I'm going to pass that rule along. Stop taking candy from strangers unless you know somebody's track record, what they're selling, what the cost is. Is their process rational and defendable? Do they run around with their hair on fire every 5% move down? Have they lived through a few cycles and kind of have demonstrated they have good temperament and character to proffer advice? Like, unless you know that, don't take candy from strangers.
Don't listen. Yeah. So I want a couple follow-up questions there. Two specific groups that you touch on in the book that I feel like I'm pretty confident you don't want people to get guidance from are billionaires who are not staying in their lane. Basically, they made their money some way else, and now they're giving investment and macro calls, and the news media. And I would imagine the billionaires frustrate you more. Is that fair to say?
No, I kind of am always amused by the billionaires, and nothing is black and white. There are always shades of gray. And I think there are things to learn from people who have been wildly successful in their career. My entire thesis behind Masters in Business, my podcast, was, hey, there's some people who are incredibly successful. What can we learn from them? So I think people kind of focus on the wrong things. When Ray Dalio is talking about debt and credit and, a history of crises, I think, and there's a chapter in the book on this, I think my lesson from Ray Dalio is we are all going to fail. Mistakes happen. That is the human condition. What we need to do is learn how to fail better and then learn from our mistakes and improve our process. Hey, who can't benefit from that advice? His particular position on where the 10-year bond goes, hey, nobody knows. But that sort of advice, a guy builds $100+ billion hedge fund, wildly successful because he learned how to fail better. Hey, that's great advice. I get the same lessons from, go down the list, Howard Marks, Mike Bloomberg, Lee Cooperman, like on and on, Mark Cuban. There are lessons to learn from these folks that are really useful. On the other hand, I recall seeing some Market Watch column. Michael Dell is buying $60 million of his own stock. And the implication was, well, you should buy the stock also. And that's a classic denominator blindness situation. How much is Michael Dell worth? Well, he's sold $19 billion worth of stock over the past 12 years, and that's how he's become the 18th wealthiest person on the planet. At least those were the numbers back when this stock purchase happened. Well, if he's worth 18 billion and the average household is worth X, what is 60 million really like? And the answer was, it's like the average American middle class homeowner buying $100 worth of stock. You wouldn't even mention it at a cocktail party. It's so meaningless. So, learn the right lessons. Warren Buffett, just a quick Warren Buffett story. Warren Buffett announces his retirement, and I know that half of the Berkshire Hathaway fans are going to want to be like Warren. There's one Warren Buffett. You can't be like Warren. But Warren Buffett has said three things over and over again that I think you need to pay attention to. And that's buy American, right? You don't go wrong investing in America. Two, own a broad portfolio based around index funds. And lastly, think about the long haul. Don't think about today or tomorrow. That's a huge lesson that so many people miss because I want to find the next Geico. I want to find the next Dairy Queen. No, you're not Warren Buffett. He had fantastic partners, investors who gave him a ton of rope to do whatever he wants. And I think you really have to recognize that we all have a certain suggestion about a certain skill set. You need to be like you're not going to be like Warren Buffett.
I love the fact that you name names in this book. And so I do want to talk to you about two in particular, because I think people still give them lots of attention, one on the personal finance side and one with kind of investing macro views. And the first is Robert Kiyosaki, Rich Dad, Poor Dad series author. And then the second is Larry Summers. Give us the Barry Ritholtz unvarnished view of whether people should be listening to these guys.
Sure. So, look, I never read Kiyosaki's book. I'm not a fan of that sort of squishy, touchy feely stuff. I like the behavioral finance side because it's academic and rigorous. But my colleague Ben Carlson had done a post called "Rich Author, Poor Reader," or words to that effect. And then somebody who runs a research shop put up a tweet stream that literally went over every single one of his tweets. And for a guy who sold, 30 plus million copies of his book and should be fairly successful, he's become a full-on catastrophist. Everything is Armageddon coming. Here comes a crash. Here comes a recession. Here comes this. Since the financial crisis, he's kind of lost his mind. Perhaps my favorite thing of his is 2018. Sell U.S. residential real estate. A crash is coming. You're hard pressed to find a better period of time in the past, other than the worst of the financial crisis, like 05, 06 with real estate, or 06, 07, the better entry point to U.S. real estate. And so when you see this sort of stuff for a guy who should know better, but unfortunately does not, you have to ask yourself, why are people following this guy? Why are they paying attention to somebody whose track record is clearly not great? And to put some numbers on it, the 15-year period ending, let's call it the middle of 2024, that's the third best rolling 15-year period over the past century. The period after World War II ending in like 1957, 18% a year. The period in 1909, the best of the technology boom, 17% a year. The crisis to 2024, 16% a year. So the guys who have been just super bearish over that entire period, anybody who paid attention to them and followed their advice did really poorly, and probably, we know they missed great opportunities. They probably lost money.
Yeah, and Larry Summers.
So Larry Summers is one of these guys that, is a good news, bad news guy. He's widely regarded as the most gifted economist of his generation, crazy smart. But to quote Paul Graham, I'm going to mangle this. All experts are experts in the way the world used to be. And what Graham refers to is, you go to college and you study economics, you go to grad school and you get your PhD and you're studying history. You live through a certain run of era as you're in your formative years. All models sort of presume that the future is going to look like the past. And as we've learned, very often the future does not look like the past. And anytime there's a major inflection point, it definitely doesn't look like the past. And so you take a guy like Larry Summers, accomplished, super intelligent, but kind of made his bones in the 1970s when structural inflation was built in, when consumer future inflation expectations were very hard and rigid to lower. And you apply that to the 2020s, to the pandemic era, everything he said about it was completely wrong. Including, you either need, a year of unemployment at 10%. First of all, this isn't transitory, it's structural. No, it was transitory. Just the size of the fiscal stimulus of CARES Act 1 and 2 under Trump, and CARES Act 3 and a bunch of other legislation under Biden. It took a while for that pig to get through the python. And so it was transitory. Transitory just took a little longer than everyone expected, because this was the biggest fiscal stimulus as a percentage of GDP since World War II. This wasn't structural. This wasn't persistent. This ran all the way up. And as Ed Yardeni pointed out, historically, how long it takes for inflation to spike is how quickly it comes back down. Yardeni was right. Summers was wrong. No, we didn't need 10% unemployment or whatever it was. 3 years of 4% or 2 years of 5% or a year and a half of 7%. No, you could even make an argument that inflation was coming down regardless of what the Fed did. Supply lines were untangling. People went back to work. They all had cash. There was all this pent-up demand. Once we worked through that surge, the Fed started raising rates just about the point in time. June 2022 was when inflation peaked. It went from 9% down to 2.5%. Less than a year. I don't think that's the Fed. I just think things kind of normalized.
I appreciate that overview. So, two investing mistakes that I see a lot now and I see over time, you addressed, I thought, really well in the book and in interesting new ways. And the first is, the danger of market timing. And I had never seen the statistic that you wrote about, which is that 31% of people who panic sell out of the market never get back in. And then you went on to say that, the rest do repurchase at higher prices. That's an astounding number.
Right. So stop and think about this. So you have to get a couple of things exactly right. And by the way, I love market timing. When I talk about a cowboy account, what I do with my 4% of liquid dumb money is the dumbest game in the world. And I go over a lot of my mistakes in the book, but if you're going to play that game, you can't do that with your whole portfolio. You set up a cowboy account so that you leave your main monies. When you think about market timing, very often it's not just things are overvalued, things have gone too far too fast. They always do. First, you have to pick an exit, and then you have to get the exit timing precisely right. If you're a couple of days or weeks early, it's painful. And you have to withstand that pain if you're either in cash or short as the market goes higher. So that's number one. Number two, you have to have some sort of process as how do I get back in? Not just I'm going on my gut, but here's what I'm going to look for and here's how I'm going to get back in. And typically, bottoms are made, especially on big sell offs, during what is called capitulation, like when a seller's exhaustion, when there's nobody left to sell. And when that happens, it's literally blood in the streets. People are just freaking out. Humans evolved as social cooperative primates. We have hardwired into us, into the human operating system. We want to cooperate. We want the approval of our colleagues and peers. It is very difficult to go the total opposite direction and bet on, oh, everybody's selling, I'm a buyer. And keep in mind, most of the time, the crowd is right. It's only when you have these massive reversals, 2000, October 07, March 09, February 2020, March 2020, October 2022. Like, it is super challenging to get the timing right, but even more difficult is you have to have the discipline and the temperament to hold your nose and get back in. And so, I don't know, I have a couple of hundred endnotes filled with references. The book is very deeply researched. There's a lot of academic and CRISP and Spiva data that I use, and Morningstar, and just a Haggerty, on and on, just a ton of data sources and academic white papers. But when I saw that number, 31% of people, who, by the way, on average, look like me, middle-aged and older white dudes who think they know what they're doing, they tend to panic sell at market bottoms, and almost 1 in 3 never return to equities. Hey, this stock thing, whenever you see someone say this is rigged, the Fed is manipulating it, in my head, I am always translated as that into, man, I bet that guy made a bunch of really terrible trades. And unlike Ray Dalio, hasn't learned from his mistake. P.S. If you panicked out in March 09, as we discussed earlier, that was the third best 15-year period in modern history, and you completely missed it.
So the second thing you talk about is being cash heavy. And I love the way that you explained that the dollar is not intended to be a long-term store of value. It's a medium of exchange. Would you mind digging into that a little bit for our listeners?
Sure. And there's a couple of great ways I like to illustrate that. So what is the purpose of a dollar? I get paid in dollars, and we all get paid in US dollars, and your job is to take those dollars and use those for what you need. So start with the classic Maslow hierarchy of needs. You pay your mortgage, you pay your rent, food, medical care, clothes, basic transportation. If you have some money left over, it's entertainment, maybe all your streaming services. You go to a show, whatever, you go out to dinner, maybe a vacation or some travel. Keep working up that scale. What do you use your dollars for? Well, of course, you pay your taxes with those dollars. You invest in yourself. You invest in your own business, whatever it happens to be. You put money into the stock and bond market. That's it. The dollar manages that splendidly. That's what a medium of exchange is. Nobody ever suggested the dollar was a store of value. And let me give you one of my favorite examples. So we all know Home Alone is a great Christmas movie. It's been coming out, every year since whenever it came out, 1990 or so. And I see these like really misleading sophistry nonsense arguments about the decline of the value of the dollar. Kevin McAllister, I think his name is. Kevin goes to the supermarket. He buys $17 worth of groceries. Today, those same dollars, that same bag of groceries would cost you $73. And the short answer is, I don't know. Are you a liar, or do you not understand basic math? And let me explain why. I went to the supermarket yesterday. I picked up some milk, some yogurt, some fruit, some salad. I didn't spend dollars I earned in 1990 that were lying around for 35 years waiting for me to go get milk and coffee. I spent dollars that I got paid on the 15th with. We all do that. Why on earth would you hold $1990 for 35 years? And in fact, this is just fundamental double entry accounting. Yes, those goods and services cost more 35 years later. But you know what? The median income since 1990, not only has it gone up as much as food, it's actually gone up a little more than food has cost. So if you're going to be accurate on a true both goods and hourly wages, inflation adjusted basis, that bag of groceries actually cost you less in 2025 than it did in 1990. But let's hold that aside for a second. If you followed my suggestions and said you went out and spent all your money on mortgage and taxes and investing, well, if you would have taken that $17 and change and just put it into a simple index fund, put it into the S&P 500, well, 35 years later, it's worth almost $275. You could go buy those $72 worth of groceries and have over $200 left. So whenever I see that come up on Instagram, whenever I see that come up on TikTok or Twitter, I know I'm dealing with someone who is either a liar or too dumb and mathematically innumerate to pay attention to. There are a lot of things that I will disagree with people about and say, hey, got to have two, it takes two people to make a trade. You need a variety of opinions. Reasonable minds can disappear. There's no room for debate here. Either you are bullshitting people with jingoistic propaganda nonsense, or you understand inflation, math, and compounding. Most things in life are shades of gray. This is pretty black and white.
This one's pretty black and white. I remember talking to you a year or two ago, and you said a lot of what drives your writing is when you just see stuff that drives you absolutely bonkers. And what's great about this book, besides the advice, the actionable advice, the well-written research, is it's an interesting read because there's a viewpoint. And as I mentioned, you name names and you give examples. I'm going to get you out of here on this because I know I have you for a limited amount of time. We both talk a lot about politics and investing don't mix, but this is a year where it's hard to avoid politics even if you want to. What are you telling people about this environment, and what is the more recent update to politics and investing don't mix in 2025?
Sure. So I'll give you 3 lines of thought on this and I'll try and keep it tight. First, in January, I do a quarterly call for clients 4 times a year. The call in January made the observation that, hey, back-to-back 25% gains in the market 2 years in a row. When we went back through history to see what that meant, just so rare, there was too small a data set. We had to go, let's find back-to-back 20% years. And, it was a range, minus 11, plus 12. But, the median clumped around plus 5 or 6%. So when you get 5 or 6 years in 2 years, 5 or 6 years worth of gains in 2 calendar years, maybe it's a good idea to just lower your expectations going forward. If we get 5 or 6% gains in 2025, I would be thrilled, is what I told clients in January before we got to Liberation Day. The second line of thought is just compare how the Federal Reserve communicates changes in policy with the stock and bond markets to how the White House did. It was very ham-fisted and shocked the market. And I think that you don't want to shock the markets, because when the market says, well, we anticipated 10% tariffs and we saw the first Trump administration, and now you're talking about 100% tariffs on 182 countries, plus on the penguins in Antarctica. We didn't build this into our models. And so people only have a finite amount of money to spend. And so if tariffs, which are effectively a giant VAT tax on consumer, even if some retailers and manufacturers eat some of it, it's still going to make all sorts of goods and services cost more. People have a finite amount of money. Our revenue expectations for corporate America are probably 10 to 20% too high based on our pre-tariff thinking. And profits always fall faster than revenues. So our profit expectations are probably 20 to 30% too high. And that means the stock market is probably 20 to 30% too high, or at least that's how the future discounting mechanism of the markets work. And so the markets began selling off to adjust to that future discounted cash flow. Um, James Carville famously said the bond market is how he wants to come back reincarnated. But I would make the argument that might have been true in the 80s or 90s. Today, it's the stock market. When I come back, I want to be reincarnated as the stock market because I remember in 08, 09, October 08, Ben Bernanke is testifying to Congress. Someone gives a fiery speech. They don't approve the new authority, new money. Market proceeds to sell off 10, 12, 13%. He testified on a Monday. By Friday, they all cried uncle and gave him everything he wanted. And then the market began its bounce back, still had a ways to go to get till March 09. Fast forward to 2020. I recall the Republicans and Democrats debating renaming a library in Washington, D.C. They couldn't get that done. Is there anything less significant to the global economy than the name that's no one's even going to notice on a library in the Capitol? And then a few days later, the Oklahoma Thunder were playing the Utah Jazz. Somebody tested positive for COVID. Not only did they cancel the game, the NBA canceled the season. And then a whole bunch of other dominoes fell. And then I don't know, maybe it's a week or two. And the market just sold it. We were in the middle of a 34%, 17 trading day crash. And subsequently, both parties that couldn't agree on the most meaningless thing passed the single biggest fiscal stimulus since World War II as a percentage of GDP. It was 10% of GDP. And then this whole crazy tariff nonsense, April 2nd, Liberation Day, down 5%, down 5%, down 5%. I think once you're quickly down 10 to 15%, politicians just can't take the pain, especially a politician like Donald Trump, who measures his success by the stock market, somehow believes that he's responsible for it, which, listen, presidents get too much credit when things go right. They get too much blame when things go wrong. The tariff issue was clearly all him, not just a broader global economy thing. And so Scott Bessent kind of came into the Oval Office and said, look, it's your presidency. These are your tariffs. It's your policy. But you keep at this and you're going to be known as the president who had a worse economy than Hoover. And so if you want to kind of just put a pause in this for 90 days, the stock market will come screaming back. But if you continue on this, you will have ended the bull market and you will be the new Hoover. I mean, that's just the rumor. We don't know exactly what was said.
Sure.
We do know that Peter Navarro was occupied and Bessent snuck into the White House, into the Oval Office and said, dude, you're killing us. And I don't care what your politics are. Bessent's a Wall Street guy. He's a stock and bond guy. He understands currencies, markets, interest rates, the Fed. I'm always hopeful that before President Trump makes a decision, the last person who whispers in his ear is not Peter Navarro, but it's Treasury Secretary Scott Bessent. That's how we end up with this sort of recovery. So what are we saying to investors? There's 5 or 6 chapters in the book on managing the noise. I did a blog post, Tune Out the Noise, kind of in the context of that. And I got a lot of pushback. You can't really tune out the noise. All right, well, here's 6 chapters. Here's how to manage the noise. Here's how to create your own all-star team of people. You can't just say ignore the media totally, but you can say, I'm not going to take candy from strangers. I'm going to only pay attention to people who I know have a legitimate, defendable process, have a good track record, have the right temperament where they don't run around with their hair on fire every 5% pullback, and who add value to my understanding of everything. Look, nobody is an expert in every topic. You want to be a broad generalist, but you want to have a team By the way, they're not on your payroll. They're just people whose Substacks you subscribe to, or whose Wall Street Journal or Barron's columns you get an alert when it comes up, or the people on TV or radio who, oh, that guy's smart. He's got a good track record. I understand how he thinks. I'm curious as to what he says and if he can flesh out my understanding of whatever, as opposed to, hey, I'm just going to take financial advice from anybody who happens to show up on a magazine cover, on TV, or what have you.
That's great insight. And you're right. You touch on that very well in the book. And I appreciate you running through it with us today. Congrats on the success of the book. I know it's a slog, but it's well worth it for people to read. And I appreciate you putting it together and talking to us today.
Can I tell you something? Bailout Nation, that was a slog to write, because every other week a different company would blow up. And it's like, oh God, I got to rewrite that whole chapter. And then September 2008, Lehman Brothers blows up. And I'm like, I don't have an ending. I got to rewrite the whole last third of the book. This book was a joy to write. This was so much fun to go back and revisit these ideas, some of which I haven't looked at in 20 years. Oh, that criticism of the Cisco cover, that turned out to be pretty good. Pointing out that Sam Zell, a brilliant real estate investor. Oh, the fact that this guy never made a penny forecasting recessions. I have a buddy who's a bond manager at Fidelity, and he said whenever Zell came to speak, the overflow crowd in the conference room where Zell was talking. And I asked, do you guys do distressed real estate investing? No, we don't do any of that. And what do you give it what Sam Zell has to say about the economy? That's not how he made his money. He bought really quality properties that the owner had gotten over leveraged and sold in a fire sale and then held on to them for decades. There, I just saved you an hour. Knock yourself out. Go buy really good properties really cheap. Otherwise, I don't really care about Zell's forecasts of the economy. In fact, Philip Tetlock at Wharton did a giant research piece and eventually became a book on expert predictions. Turns out that the experts know better than anybody else.
Yeah, that super forecasting, was that his book? Yeah,
that was the follow-up to it.
That was
the original book was kind of dry and academic based on a white paper. Super forecasting was after expert judgment. They did find a group of people who performed better than average, and then they show you the process. What do you know? What don't you know? That's how you make a better forecast. Like most people, you ask them a question, how many cardiologists are in London? And the correct answer is, I have no idea. The second answer is, well, what's the population of London? What's the average ratio of cardiologists to population? Their socialized medicine, is it more than the US, less than the US? You put together a series of rational questions, and you can kind of tease out a better than 50-50 answer. But most people don't go that way. Most people don't stop and think, why am I answering a question that I have no idea? You know, it's standardized testing should have taught us, if you take the SATs, the GMATs, the LSATs, the MCATs, whatever, you get a point for the right answers. You lose some percentage of that point for the wrong answers. Don't just make wild guesses. Put some thought into it. And if you still have no insight, one day someone besides me is going to say on TV, where's the Dow going to be in a year? How do I know? Nobody knows. It's just pure guess. 12 months is so long. There's so many random events that happen, like a pandemic or a terrorist attack or a Russian invasion or God knows what. 12 months is forever when it comes to forecasting markets and the economy. Just stop and make sure you're building a portfolio that's robust enough to withstand anything that gets thrown at it.
Not only how do you know, but why do you care where it's going to be in 12 months? We know where it's going to be in the long run.
I love when people ask me, hey, so COVID, you think that was from the wet market, or do you think that was a lab leak? And I'm like, well, let me tell you why I'm absolutely the wrong person to ask. I have no access to national security. I'm not a virologist. I'm not an epidemiologist. I'm not even a doctor. Why would you think I have an opinion that has any validity on this topic? So shame on you for asking me or anybody like me, and shame on the idiots who answer that instead of saying, I don't know, I'm the wrong guy. Go speak to, Charity Dean, or go speak to the head of the CDC. Charity Dean, the lead character in the Michael Lewis book, Premonition, former Secretary of Health in California, who was warning people way in advance. Go ask them. I don't know.
Yeah, I don't know is definitely underutilized, particularly in our industry. And one thing I really appreciate, besides the time that you gave us today, is this is a Boston-based podcast talking to New York guests, not bringing up the Celtics, Knicks, or doing any NBA analogies because it's still a little raw.
So, I've been a Knick fan since the, 70s and 80s. And, the Patrick Ewing, John Stark, Charles Oakley, Anthony Mason era. And last night's collapse. Oh, now we're back to what I'm used to. This winning and coming back from behind. And that doesn't make any sense to me. But, giving up a 20-point lead in 3 minutes. Oh, okay. Now I'm back to my comfort zone. This is a sort of nonsense I'm used to.
Well, I appreciate you saying that. Thank you again, Barry. And I would recommend everybody check out your book. I appreciate the time.
Thanks so much, Sammy. Really appreciate it.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Kristen Kastner and Michelle Kakanis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast are that of the speaker, are subject to change, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal. There has not been and will not be any compensation exchanged between Heritage Financial Services and podcast guests or recommended resources.